Hello, I'm Adam Werner, Wealth Manager with the Haas Financial Group. Today I'm going to give you a quick walkthrough or a quick tutorial on our risk assessment tool, Nitrogen, formerly by the name of Riskalyze. So where we like to use Nitrogen is to help figure out what risk level are you comfortable with when it comes to your investments. So oftentimes we'll either send this link to you directly. It is available through our website as well. But let's dive into it. So we click this Get Started button, and it's going to give you an option here to select some financial goals right off the bat. You only have to choose one, but you can choose up to three. You can add your own custom goal in here as well. I'm going to choose retirement for our purposes. I think that's oftentimes where people find us most frequently is around retirement. So let's go with that. The second question here is, it allows you to input anything you want to put in here about your financial status. If you wanted to put in, specific retirement kind of time horizon, or if you expect an inheritance in the near future, maybe you just received one. If there are any major expenses that you foresee coming up in your life, feel free to put it in here. I will share that that is not a requirement, and it doesn't necessarily impact the risk score. So certainly feel free to skip this, but anything you put in here, more than okay, and it certainly could be helpful for future conversations if it's not something we've already talked about. How much do you have to invest? So this screen is an important one because ultimately this is going to drive the risk assessment part of this tool. Often this number will be pre-populated based on information that you may have already shared with us and that we may have already input into this tool. But what we want to focus on here is any savings or any investments that you have that you would want to either put in the market or that you already have invested. So for example, if you had a 401k at work, you would want to add that dollar amount in here. If you had a brokerage account that you invest in outside of your employer retirement plan, if you had savings in the bank that you're looking to invest in the stock or the bond markets, we would want to add all those numbers up to kind of give us that total investment amount. So our purposes today, I'm using a nice round number of $1 million, and we'll kind of see how that factors into the actual risk questions. When were you born, and at what age do you plan to retire? Again, this screen is not required. Certainly feel free to put information in here, but it's not a requirement to go through the actual risk assessment. There are two questions here that are more for conversation. They do not affect the risk score itself. But what we found is that through a lot of conversation, when we walk people through this tool directly, it impacts the conversation, not so much the risk score. So feel free to answer however you feel about the market right now. Do you feel positive or negative? I'm going to say I feel positive. And I should clarify too. How people answer this is completely relative, and how you interpret the question. Some people respond to this in a short-term manner. Sometimes you can look at it from the long-term point of view. That's completely up to how you interpret it. Again, you don't necessarily, it's not going to impact the risk score, but like I said, it's good for conversation's sake. Similar question here. How do you feel about your financial future? Do you feel confident? Do you feel anxious? Again, it's not going to impact your risk score. It's more for facilitating a conversation. So here's where we get into the meat of it. This blue circle here in the middle is a slider. And as you see, you start to move this slider as our starting point. This is where we want to try to find that baseline. But as you can see, there's a lot of information on the screen kind of all at once that moves along with that slider. So I'll kind of give I'll give the lay of the land when it comes to what do these numbers actually mean. So Riskalyze, or Nitrogen now, is probability and statistics based. So as you see here, it's thinking about the next 6 months of the market returns or of your investments. Why 6 months? Again, it's probability and statistics driven. So over a 6-month period of time, there's a 95% probability that depending where you move this slider, that your investment returns will fall somewhere between those ranges. So if we look at the percentages here, you have a 95% chance that your returns will fall between 16.4% of a gain or 10.4% of a loss in any given 6-month period of time. So it's giving us these guardrails on our market experience. So what I think we would want to draw your focus to is this I'm comfortable risking number down here, because ultimately what we found is that, well, I think for many people, the losses hurt way more than the gains feel good, historically speaking. So a different way of kind of going about this is, what's the amount that you would need to lose in a 6-month period of time that would force you to make a big change in how your investments are managed or how they're allocated? Because ultimately, we want to avoid investing in a portfolio that you won't be able to stick to over the long run. We especially because we know that market volatility is a normal part of investing, but sometimes that volatility can be a little bit higher than we would like, and it can also last a lot longer than we're comfortable with. So ultimately, we want to be able to try to find a happy spot here, or a middle ground where you're able to kind of ride out the fluctuations in the market and avoid selling in what may be an inopportune time. So for our purposes today, let's say I would be comfortable risking 100,000 on my $1 million, so 10% to the downside over a 6-month period of time as a starting point. Now it's going to give me this range of, here's what I could potentially gain over a 6-month period of time for that potential risk of losing 100,000. And it's also going to give us a target annual return, that a typical portfolio with that range of returns over a long period of time historically has returned roughly 5.8%. So there's different ways that you can kind of go through this questionnaire, or where you can start with where your focus is. We think it's best to kind of focus on what you're comfortable losing, because ultimately in the real world, when it comes to your money and investments, that's where we've seen it's the emotional impacts, the psychological impacts of seeing the fluctuations on your statements that really drive the experience on your comfort level. So let's start there, and now we'll get into some clarifying questions. So if the market dropped quickly and this $1 million portfolio dropped by 89,000, would we stay invested, or would I want to sell and reduce risk to hopefully limit any further losses? We again answer it however your gut tells you to. I'm going to say stay invested. We believe that over a long period of time, we know that the market has always rebounded in the past to varying degrees, right? It doesn't always rebound as quickly as it has before, but the market has always gone on to make new highs. So we would hope that we can ride out those market fluctuations. Now, it's going to start to give us some different scenarios and put that comfort zone to the test. So would I choose this range of return? So this is where that slider was on that very first screen. So for a potential gain of 156,000 or a potential loss of up to $99,000, let's call it. And when you hover over these different options, it'll give you the percentages kind of on this spectrum. So that's option A, or option B being a certainty of gain of 2.3%, or in my scenario, $23,000. I said from the outset that I would be comfortable over that 6-month period of time choosing option A, so that's what I'm going to choose here. But there'll be a subsequent fine tuning of that range and of that certainty of return that I'd be comfortable with. So let's go through it. So now this option A did not change. That range remained the same, but option B now went up to a certain gain of 46,000, or 4.6% on my $1 million. So now maybe it's a little bit more difficult. 4.6% guaranteed is certainly better than the 2.3 that it was showing. But depending where you're at, phase of life, depending your comfort level with just risk overall, this range of return may still be comfortable. There are no right or wrong answers as you go through this. I guess I should have clarified that from the beginning. So really just answer it with kind of your initial instinct, which one feels the most comfortable to you, because ultimately that's going to give us better insight to what portfolio will match your comfort of risk and your ability to kind of ride out volatile markets. So I'm going to choose option A for here. But now, again, it's going to fine tune. So now it's giving me the option of up to 5.8% certainty of gain for that same range that I said from the outset. Now I'm going to choose that certainty. If I could get close to 6% guaranteed without any kind of risk of loss and not have to worry about this range of returns, I think I'd be comfortable with that. So let's choose that one. And now it's going to give us a slightly changed range. So now it's going to give us the same range of gain or loss, but now the certainty of gain has dropped to 5.2%. Again, no right or wrong answers. So I'm going to say, well, for 5.2%, I'm willing to risk that range of return again. And here we go. It's going to give us one last question. So option A has now changed. That range of returns, the potential gain has increased to 18.3% or almost $183,000. But the loss, the potential loss has now grown as well, 11.8% to the downside, or roughly 118,000. But that certainty of gain has also moved to 6.5%. So again, no right or wrong answers. And I would say if I was comfortable with 5.8% earlier, I'd say, yeah, I would take a 6.5% certainty of return over a 6-month period of time. Let's choose that one. Ultimately, what the tool is going to give us is a risk score on a scale of 1 to 99. 1 being cash with no market risk or no investment risk, and 99 being the riskiest stock that you could imagine in the markets right now. So clicking through the way that I did, it gave me a risk score of 58. That's almost down the middle, but kind of leaning on that moderate to moderately aggressive approach over a 6-month period of time. And it's going to give us that range of returns that we may target. Now, this is not set in stone. We're not going to invest exactly as this says, but it gives us a starting point and an understanding on kind of how you would feel in certain market environments, or how you approach your investments and how you approach risk. So if you think, yeah, that feels about right, I'd be comfortable with that. You can click, yes, that feels like me. It's going to confirm the process. We'll get an email. It'll get kind of confirmed within the risk or the nitrogen tool. But if you don't feel like that fits, you can go back through it. You can say, no, I want to make an adjustment. And you can go back through some of those similar questions. And depending what you choose, those questions, those clarifying questions as you go through will be updated as well. And I should state here too, how you feel about risk and where you're at on the spectrum now may be very different than 3 years from now, 5 years from now, 10 years from now. This is something that we'll revisit every once in a while because your phase of life will dictate potentially how you feel about risk, where you're at kind of in retirement or where your investments are. Will start to change how you feel about risk over time. That is very common. So as you go through this, if you have any questions or run into any issues, please feel free to let us know. Shoot us an email, give a call to the office, and we're happy to talk through it. Thank you.